This screencast is focused on May 2016 question 2, looking at IAS 7 statement of cash flows and also journal entries. So the statement of cash flows has come up in two ways to date in the CAP2 financial reporting interim assessment. Firstly, as part of question 1, where again you have to prepare both the P&L, statement of financial position, and then also a cash flow. So take an example there of September 15 question 1, so where all those three came together. And the other way cash flows came up was that you were given a statement of cash flows and asked to do the journal entries for it. So that would have been May 15 question 3. Again, that was a more unusual one that students wouldn't have seen before, but it is useful to practice on it. As was now here in May 2016 question 2, we're asked in a variant of that where you're asked to both prepare the statement of cash flows for 20 marks using the indirect method, but also prepare the journal entries relating to the investing and financing activities of OHM for the year end 2015. So you have 30 marks in total. So for a 90-minute exam, you're talking around 25 minutes. So again, always put that in context. Can you get this question out in the time required? So approaching preparing a statement of cash flows is completely different than a P&L and a statement of financial position. And it's important you practice that in your own right, because particularly for question 1, students can over-focus on the P&L and the SOFP, and they never look at IAS 7 statement of cash flows. But in essence, the core concept of statement of cash flows is you'll typically be given or you'll have prepared 2 statements of financial position, and all you're trying to do then for each of the balances is reconcile the movement. How do we get from 1.6 million to 1.9 million for PPE? And what you will use is you'll use the notes, the information in the question, and whatever the plug figure is then will be the element that goes into the statement of cash flow. So to some extent, you'll start off knowing where you need to get to, and you're trying to fill in the blanks then. So it is a completely different way of approaching preparation of financial statements. It does take practice, but again, the more questions you can get under your belt, the more mechanical this type of question becomes, and it actually is a nice one to see on the day of the exam if it does appear. Just to note, there are 2 different approaches to preparing a statement of cash flows initially. You have the direct, but you also have the indirect method. Now, both are examinable. Typically, the examiner will not explicitly ask you the direct method, but again, just to know it is on the syllabus as well to make sure you cover it. So in this case, we're going to start off with the indirect method. What this essentially says is you start off with a profit figure for the year. You then add back, typically depending on what profit figure you start with, you may add back income tax expense and the finance cost expense, because again, these may not be the actual amounts that are paid. These are just the amounts that are expensed to the P&L. So we'll add back income tax expense and finance cost expense. So that you're kind of indirectly getting back to cash flows. The next key adjustment that you'll make is you'll add back non-cash expenses. So non-cash expenses. Again, we'll figure out in the question, do we have any of those? Typically these are around depreciation, amortization, but you may also have other ones, from example IFRS 2, depending on the context of the question. But remember, this is an open book exam, so it's no harm to have a little summary sheet done out. What are all the different types of non-cash expenses that I should watch out for in a question? So that's making your strategic use of the open book exam. Once you have the non-cash expenses complete, and I'll just leave a couple of lines there because we don't know yet, you will do your working capital movements. So working capital movements involve inventory, trade receivables and trade payables. If they move, and you'll know from your CAP1 finance, if working capital moves, that is good or bad for cash flows. And that's what essentially you're doing here. We're looking at the movement of working capital and how is that impacting the cash flows for the year. And finally then, once your working capital movement's done, you finally take off your interest paid and your tax paid for the year. And please note that these 2 figures may not be the same. So the amount you actually incurred as an expense during the period may not be the same as the amount you've actually paid in cash, depending on whether you have an opening or closing accrual or liability in the statement of financial position. So that's why we try and distinguish there, because these amounts may not be the same. All right, and that's essentially getting all those figures gets you a cash flow from operations. And that's the key starting figure. You get cash flow from operations, then you go on to investing activities, and finally financing activities. But we're going to start the question now by focusing on getting cash flow from operating activities. And one of the nice things about statement of cash flow question from the outset is that we actually know our answer that we're working towards. So if we just come over here, and I always tell students to this, get the opening balance, and remember it's called cash and cash equivalents. So that means cash and any other element that is between 3 months of maturity. So short-term deposits, and also include there any overdraft if you have it. So the opening balance here is 60,000. Take it from here, and we have no other cash equivalent, either an overdraft or short-term deposit. The closing balance on cash and cash equivalent in this case is 126, meaning the movement for the year is a positive 66. So now we know already we need to get back to 66 being our answer at the end of the year, and if we haven't got back to that, we know we've gone wrong somewhere. So that's why it's a nice type of question that you know exactly what the answer is before you start, and you can try and back in and figure out where exactly you've gone wrong if it doesn't come back to that. So now that we have the answer ready and we know what we're aiming for, let's start off with our indirect method. So we'll put in here, again, don't lose any presentation marks, statement of cash flows for year ended 31 December 2015. So just keep everything nice and neat. The starting point here, we're told what our profit after tax is. It's 380,000. So I'll just format all these to make sure they're all the same. So 380,000. However, we know that's after tax. So we've charged income tax for the year, and we're also told here we've charged finance costs. So we add back them typically of 50,000, and we also add back finance costs of 36,000. And why we do that is we're not sure if there's the actual amount of cash flow that we've paid in the period. We may just have expensed that, but we may not have actually paid that amount, or we may have paid more depending on the movements in the statement of financial position. But the first key point is always you add back your finance costs and add back your tax expense for the year, because it's profit after tax. So again, it's important to note that depending on what profit line you start with, you may not have to add them back. So if you start with operating profit, these are already added back. They're not included. So just be careful of what profit line you started with. We started here with profit after tax, hence we're adding them back. We've only one non-cash expense here, which is depreciation. So that's really just an accounting entry. It's not actually a cash expense. And we'll add back there 340,000. So again, we're gradually building it up to a more realistic cash flow, which is 806. And now we have what to do working capital movements. And what I typically tell students is, when you ever have a working, particularly for bigger financial statements, put a little note column and do your workings over working one. So I'll reference all of these working one. I typically leave my first page for my statement of cash flows, your core financial statements, and I might come over to another page here and I'd cross-reference, for example, working one, and we look at working capital. And in this case, we're going to look at three elements. We're going to look at inventory, we're going to look at trade receivables and trade payables. And what you're typically looking at is what has been the movement from the opening balance to the closing balance. And then we get our movement. So a lot of it is fairly straightforward at the outset. It's the opening balance was 420 for inventories, and it's gone up to 460. The opening balance on trade receivables was 280, and now it's gone up, or it's gone down, should I say, to 260. And trade payables then, opening balance was 790, and that's also gone down to 760. So that's the most straightforward thing initially. Sorry there. And then you're trying to get the movement. So it's just the closing balance minus the opening balance. So the inventory has gone up by 40, trade receivables have gone down by 20, and trade payables have gone down by 24. So typically most students are very comfortable getting to that far, but what they are poor at is impact on cash flow. So you have to try and ask yourself, is an increase in inventory good or bad for cash flow? And likewise for trade receivables and trade payables. And the key point is here, inventory, an increase in inventory is a negative effect. So I'll just say a negative impact on cash flow. Because if you have more inventory, that means you have more money tied up in stock. That means it's an outflow in terms of cash, it's money tied up. If you have a decrease in trade receivables, that means less people owe you money. That's actually a positive for cash flows. And finally, if you have less trade payables, that means you owe people less money. So you've paid off more people over the period. That is also similar to the inventory one. It's a drain on cash flow. So the key point is these two are consistent. So if it's an increase, it's bad for cash flow. If it's a decrease, it's good for cash flow. This one is the opposite then. So if you try and remember it like that, these two are the same. An increase is good for cash flow. Sorry, an increase is bad for cash flow, apologies. And a decrease is good for cash flow. So you have less money tied up. Whereas trade payables is the exact opposite. A decrease is bad for cash flow and an increase is good. But that's typically where students struggle. So we now have a minus 40 going to the cash flow statement because it's negative, a plus 20 and a minus 24. So that's where students can struggle because they confuse the movement with the impact on cash flow. So just bear that in mind and make sure you go back and practice that for other cash flow questions. So inventory, trade receivables, trade payables. So inventory is a minus 40,000, trade receivables is plus 20,000, and trade payables is minus 24. So if we just try and I'll just put these in nice and neat to make sure we're all able to read them. So if we take that then and look at the movements of the working capital as well as the subtotal, we're down to 762,000 cash before we paid interest and tax. Right, so again, make sure you stop this every so often and try and attempt the next couple of stages yourself without just waiting and looking for the solution. The next element of this is figure out what is interest paid and tax paid. And it's important here to get into this practice of using your statement of financial position to figure out, well, is the amount in the P&L the correct amount to go into the cash flow? So if we look at something like, we'll start off with finance costs. So we had a finance cost expense, which is 36,000 for the year. Did we have any opening liability or closing liability related to finance costs? So we're looking at our current liabilities, and we didn't. There's nothing about accrued interest there. So we can assume then, well, I'll say from the SOFP, that we paid 36,000 during the year. Because if we incurred expenses of 36,000 during the year, we'd no accruals, because everything is trade payables or tax, therefore we must have paid cash of 36,000 during the year. Now, tax, as we'll see here, is slightly different. That we did have an opening amount of 60 to pay, but we only had a closing amount of 40 to pay. So whatever way you wish to do this, it's important that you understand that you didn't actually pay just 50,000 of a tax expense, because there was an opening and closing movement as well. So we'll look at working 2 for this. There's 2 ways you can do this. You can open up a T account, which I'll just do here briefly to show you. This is typically more so for the longer questions than the more straightforward ones that you might get in an interim assessment. But it's useful to practice nonetheless if you get a complicated one. So in tax, we had an opening balance on the credit side, a liability of 60, and we had a closing balance, which is like your balance brought down. It's on the debit side, but it'll be carried over to the credit side of 40. So that's how your T account would look. For tax, you have an opening balance of 60, and again you have an opening balance brought down for the subsequent year of a 40, and that's how it's shown up. And we also had tax charge for the year, in this case of 50,000. So how we show that is you debit the P&L and you would credit, so I would put blocky here, that's how much is charged to the P&L for the year of 50. So to make this balance, it obviously doesn't balance now, the T account. We have 110 this side, so there must be a plug figure, and that is your bank figure of 70 this side. And both of them sides now sum to 110. And I suppose the logic is there, that must have been the amount you paid. If you owed 60 at the start, you incurred a bill of 50 during the year. That means you owed 110. And if you only owe 40 at the end of the year, you must have paid off 70 during the year. So when you get more complicated, it's useful to use T accounts to help you explain all those movements. So I'll just put working 2 tax paid minus 70. And we can sum them up, getting our cash flow from operations to be 656,000. So that's your first key subtotal done. Cash flow from operations, I might just put this out in this column, 656. Now, instead of doing the T account, what you can just do is start off with the opening balance and say I owed 60 at the start of the year. The splotchy element for the year was 50, which means 110. Owed at year end is 40. Therefore, how much was paid? Paid during the year was your 70. So you can by all means do it in a column, and some students feel it's a lot quicker that way if you can understand intuitively what's going on. But just make sure you're comfortable enough that you don't make a slip in terms of adding or subtracting. That's why a lot of the time a T account can make it very helpful to look exactly what's going on, particularly when you're under exam pressure. Right, but that's the kind of logic we're going to use for the rest of the line items to help explain the movement throughout the period. So we've now finished cash flow from operations, which is 656. You will also have a cash flow from investing, what's called activities. And you will have, when I just leave another space, cash flow from financing. So I typically tell students start off and do the operations down, because that's a typical standard approach to doing cash flow from operations. Then set up your headings, investing activities and financing activities, and just leave a couple of lines. Because then what I tell students is, just to make sure you don't miss any line item, is start in the statement of financial position and work down and explain every line as you go down. That avoids you making any mistake, and you'll always make sure you've hit every line item. Because the statement of cash flow is essentially asking you explain every movement for the statement of financial position. And we'll have some of them explained already, and others we'll have to get to as we go down along. So for example, we're going to start here now with the property, plant and equipment, and we're trying to explain, and again I'll open up working 3. So I'll just take a T account like this. So this will be in a separate page. You'll put working 3. Let's bring it down here. And we'll say property, plant and equipment now. So obviously we won't have opening balance on the credit side. Just change them to white. So if we have an opening balance here, this is the kind of logic you need to use, 1620, and then we have a closing balance here of 1930. We're trying to figure out then what helps explain that movement. And you will use the information you're given in the case to say, do I have any line items that I know will help explain property, plant and equipment? And of course we have one obvious one. Here we have depreciation charge for the year was 340. So that's a good thing to put in your little cheat sheet or summary sheet. Yes, depreciation will be a non-cash expense. To add it back, it will also help explain some of the movement in my property, plant and equipment. So you will debit depreciation, you will credit accumulated depreciation, or here, because both accounts are netted together, it will be depreciation of 340. Okay, so we've now, that's all the information we have. So the plug figure must be a cash movement during the period. So in that case, the sum of this side is 2270. There's obviously less here, so there must be a plug figure on the debit side of 2270 minus 1620. And that again is bank. So that's telling me we bought property, plant and equipment during the period, purchase of PPE for 650. That if we started off with 1620, we depreciation is 340, we must have spent another 650 to get back up to the closing balance of 1930. So all I'm doing is that is an investing activity, purchase of PPE, and I cross-reference a nice neat working 3 minus 650. Minus 650 because that is an outflow. Alright, so again, that's your working 3. So that's our first one explained. We've explained property, plant and equipment. It's 650,000 purchase of PPE. We've already explained inventories because we've used that in movement and cash flow. We've already explained trade receivables, and this is our answer. So we never put that anywhere. That's the answer we're trying to come back to. As we've calculated already, the movement will be 66, hopefully, at the end of our statement of cash flow prep. So you can see a lot of the time you'll have some of these done already, so you won't be reinventing the wheel. You're just making sure you're going methodically through each so you don't forget a line item. Because if you forget one line item, the thing automatically will not balance. Ordinary share capital and ordinary share premium we typically take together because any transaction will impact both together. So I typically take them together and look at them as one working. We can clearly see here there has been some movement to the year. We're not told any reason for that movement, so that must be a share issue. So again, some students are very quick off the mark here and they don't need to do a T account out. They can clearly see we started with 120 in share capital, share premium, and we're now at 260. So there must have been a share issue during the year of 140. So if you want to do it like that, just show your logic to the examiner. But if you're quick and you can click with that in the question, by all means that will save you a lot of time. Some other students prefer to do it out from first principles. So we'll just do that out here, working 4. Again, I'll bring down the tax one again. So ordinary share capital plus share premium. So I just do them together. Just that. So the opening balance for ordinary share capital share premium will be 120, and the closing balance we know is 260. So we have nothing else here, that there's no other movements we're told of in the question, so it must be a balancing amount of 140 here, and of course that will be bank. And why will that be bank? Well, that will be bank because it'll be debit bank in terms of your share issue, and then you'll either credit share premium, which you will here, 40, and you'd credit ordinary share capital, 100. But we're not too worried about what the split is because we're just interested in the cash amount, which in this case is a share issue to the tune of 140,000. So I said you could have done that very quickly from the face of the statement of financial position, or if you wanted to, you can do it from first principles using a T account. Both are going to come to the same answer. That goes to financing activities, share issue, working 4, 140,000. So again, we're slowly but surely filling in each of the line items. The next one is one where students do struggle because they automatically nearly leave it out, but it is important in terms of retained earnings. Can we explain the movement in retained earnings from how do we get from 1290 up to 1570? So again, you have to ask yourself, and this is based on your knowledge of financial statements, what moves retained earnings? And there's two main elements that move retained earnings. There is profit for the year, which we're given as 380, but also, particularly note 3, there's dividends of 100,000. And one of the key points to remember here is you wouldn't have to be told what the dividend figure is. The examiner was just being nice there. We'll show you should be able to prove that dividends were 100,000 from the question. So if we go over here to working 5, just put working 5 there. And we're now looking at retained earnings. So I'll just clean that off again. The opening balance in retained earnings in this case was 1290, and the closing balance was 1570. And we're trying to explain, well, how did that come about? What happened during the year that moved retained earnings? The two main ones being profit for the year, which in this case we know is 380. So if you get profit for the year, that increases retained earnings. So we're now at 1670. But the closing balance says it should only be 1570. So that difference to balance up must be 100. And again, that is bank, which is also known as a dividend. Because if you pay a dividend, you credit bank and you debit retained earnings. So that's what I'm saying. In some questions, you may not be told what the dividends are, but you should be able to prove from the movement in retained earnings that will be the plug figure. So just watch out and put a note there that even if that number 3 wasn't there, you could still figure out the dividends are 100,000 euro. by the movement in the retained earnings T account. So if we come back here, now dividends can go in either as a financing activity or in operations. We're going to put it in financing, but there is the option there under IA 7. They don't prescribe exactly where it needs to go. So we're going to say here dividends paid. Dividends paid, working 5 of minus 100,000. So remember, it is minus because it's an outflow. So that's our retained earnings figure explained. We now say, well, long-term loan has actually gone up. So again, there's very little need to do any T account here. You can if you wish, but the key point is, how do we go from 120,000 up to 140? Well, from a finance perspective, we had a drawdown of long-term loan to the tune of 20,000. Again, you don't need to go any more complicated than that. I just say that from the SOFP, that it shows that will save you time. There's no other movement in terms of long-term loan. Again, I wouldn't, some students say, why won't you assume that the finance costs might be accrued in there? If the finance costs were accrued, they would be in current liabilities because they would be paid you for within the next year. So technically that wouldn't be correct. So similar to share capital up here, if you just look at the movement, and there's no other explanation, you can go straight in to the statement of cash flows. So again, I'll just tidy up this because we didn't have any more. So actually now, our cash flow from investing activities for the year are 650, and our cash flow from financing activities are 60,000. So remember, we hoped that the movement in cash and cash equivalents for the year, we hoped they were, based on our initial calc, 66,000. And in this case, if we add them up, 60 minus 650 plus 656 gets us to 66. So thankfully we are on track, we know we're correct. And typically to finish off, you put in the opening balance and you put in the closing balance. That's typically what's shown in the statement of cash flows. That is 60, so 60,000, and then that is 126. So that's typically how it's shown on the statement of cash flows, with this one then being the total. So that's important in terms of, it was a fairly basic statement of cash flows, but nonetheless they do appear, so you need to be able to prepare them either as part of a question 1, or in this case based on May 16, as a standalone basis. And in this question you were asked the indirect method, but you could also be asked the direct method. So the final element of that question was looking at prepare the journal entries to reflect the transactions from the cash flows from investing and financing activities. So it's important there that you read the question fully, that you weren't asked to do all these journal entries, just the journal entries for these 4 line items. So if we label them 1, 2, 3 and 4, and that's why it can be useful to do the T account if you ask this question like this, because you have a lot of the journal entries already done. So the journal entries for point 1, the purchase of property, plant and equipment, if we go back and look, well, it's going to be debit PPE, and of course the corresponding one will be the bank account, and for debiting PPE it must be credit bank. So there's nothing more complicated than that. It's debit PPE 650, credit bank 650. That's all they're looking for. That's what they mean by the journal entry. It's an unusual one, but they did come up before, as I said before, in May 15 question 3, where you're asked to do journal entries based on the statement of cash flows. For the share issue, and this is where students may get caught out, make sure you split it between the share premium and share capital for the journal entry. Yes, it didn't make any difference here because we looked at the 2 accounts together, but you're going to debit bank 140, but just make sure you split it out between the ordinary share capital, which you know here the movement was 100, and share premium, which the movement was 40. So that's just where you'll get caught out there. It'll be debit bank inflow, credit ordinary share capital, and then you'll credit share premium. So debit bank 140, credit share capital 100, share premium 40. And how I know that split is I'm giving it to it in the SOFP. Share capital has gone up 100 and share premium has gone up 40. The next one looks at dividends paid. So we know from our T account the dividends paid was debit retained earnings, because that's what we have in our T account. The corresponding entry is in the bank account, and it's a credit. So that's why it's useful. You have a lot of the work done already. It is debit retained earnings, and in that case it is 100, should I say. So 100,000, and then you will credit bank 100. The final one then, we didn't do a T account for the long-term drawdown of the loan, but in this case you should hopefully try and make sense of what's going on. We drew down the loan, so the obvious one is the loan went up, credit long-term loan of 20. So you know the loan has gone up by 20,000. And what am I going to debit? Well, I'm going to debit bank, because if you draw down a loan, the first place the cash goes is into your bank account. So it increases cash for the year. So that is the simple entry for the final one. It's debit bank 20, credit long-term loan 20. So ultimately that is all the question 2 on May 2016. As I said, it was a variant of cash flow questions that have come before, where you're both asked to prepare the statement of cash flows on a standalone basis and also prepare some relevant journal entries. So make sure you go back and practice statement of cash flows on their own first, but then look at them in the context of a question 1, where you also have to do a profit and loss in a statement of financial position, and also look at the May 2015 question 3, which gave you a statement of cash flows already prepared and you to do all the journal entries. So very similar enough to part B there, but again it was the first time they had come up in the FR exam. So that was May 2016 question 2, IA 7, statement of cash flows.